how do I get to a level that seems at this point unattainable?
There are a lot of questions about building wealth in the stock market versus from the real estate market. Most of these stock companies' advice, they tell you to put very little in real estate. And if they tell you to put money in real estate, they tell you in real estate investment trust, which I consider to be the stock market, not the real estate market. So, but what I've actually experienced is that most of my hundreds of clients and investors through the years built their wealth in real estate, not in the stock market.
The stock market in particular is driven by the twin forces of fear and greed. And you get a sense of that. You can see what's going on. And the market will tend to move in big ways. So you move, as the market's rushing up, there becomes more and more greed. And when you get at the top, the greed is at its pinnacle. Everybody's investing in the stock market. And then it begins to crash. And everybody starts exiting at the same time, which causes it to crash further. And at the bottom, there's total fear. People are frozen solid and won't do anything. And if you want to be a successful investor, you have to learn to be counterintuitive in your actions. So when everybody's like, the market is the best thing going and you can't help but make money in it, that's the time for you to start taking some chips off the table and sticking them in your pocket. And then at the bottom where people are just scared to death, that's where you start taking your money out and start to systematically put it back into the market. If you can learn to act in that counterintuitive manner, you're going to be successful as an investor.
One of the best ways is what's called dollar cost averaging. So as an example, if you're going to put $1,000 in the stock market, maybe you put $100 in every month. So if the market's going up, you're buying less stock, and if the market's going down, you're buying more shares of that stock. So that's a good way to do it.
People think that CDs are an investment. CDs I call certificates of devaluation. They're not an investment.
Let's talk about certificates of deposit. So right now, if you look up USA Today, a 5-year certificate deposit is about 3.4%. 3.4%. So let's say you invest $100,000 and you get your whopping 3.4%. So you got a whopping $3,400, right? Wow. Okay. Now let's say that the average person is in about a 40% tax bracket. So let's say 40% is the tax rate. So based on my number, you're going to net at the end of the first year about $2,000, right? Now, so if you got $2,000 at 10 years, what's 2,000 times 10? $20,000. At the end of 10 years, you're going to make a whopping $20,000. So you're $100,000. Now this means today you can go out and spend $100,000, right? So that means I could buy a car and food and gasoline and maybe a down payment on this and do that. In 10 years from now, if you have inflation chipping away at 3 to 4%, can you still buy $100,000 worth of goods in 10 years? No. So, on 3 to 4%, the discount rate is about 0.7. So at the end of 10 years, your $100,000 is worth a whopping $70,000. How do you like that? Now, so that means at the end of 10 years, you got 70 plus 20, you got $90,000. I know, somehow I feel robbed.
You're better off listening to stock analysis or coming up with your own opinion.
No, I like doing both. I like listening to analysts or reading analyst reports, but ultimately you need to be your own person. You need to come up with your own ideas. Or either you're going to take your money and you're going to turn it over to a professional and you're going to trust that they're going to do a very good job in terms of managing that money for you.
There is a negative correlation between analyst recommendations and market performance. So you are more likely to lose money if you're following analyst recommendations. That's statistics. What I recommend, again, I have 4 easy questions and a stock report card. So if you want to invest in individual companies in less time than it takes you to read one article in the Wall Street Journal or the New York Times, which are the best journals out there, other than NataliePace.com. In less time than that, you can actually have good forensic analysis of your own. And 3 out of 4 questions you can answer as a consumer.
So I finally have a little money these days, and I'm wondering what the best way to diversify my portfolio is.
There's 2 rules of thumb about making money, right? I think it was Andrew Carnegie said, if you want to get really rich, you put all your eggs in one basket, but just really watch the basket. Right? So he was about concentration to really make his wealth. But once you're wealthy, if you want to stay rich, you got to sort of diversify. As you're building your portfolio, when you're younger, it's better to probably be in, things that are a little bit more risky, like stocks. Until you get older, then you can start, crossing over to bonds.
What's more important than diversifying is annually rebalancing and also hot industries. For instance, the Dow Jones Industrial Average, 13% were bailed out. It was the bailout index. So today's blue chip is no longer the old school. You always keep a percent equal to your age safe, and that is not in the stock markets. And each year it changes what's safe, and this is kind of important. So right now I would say the safest spot is going to be a money market that's FDIC insured, and a lot of the brokerages have that. And the other thing is, it changes. So you do need an ongoing source of good financial information. So I got to give a plug for my site. Sorry, gang. NataliePace.com. I do it ongoing, and it does shift, but a percent equal to your age safe at all times. And then the other part, diversified into 10 funds. It makes it really easy, and annually rebalancing.